So let's start with the recording business transactions second part, in which we try to learn how to record business transaction in T accounts. So again, with the same example, like a Terra Corporation chart of accounts we discussed from the previous one. That's a cash, accounts receivable, office supplies, office furniture, land, accounts payable, notes payable, common shares, dividend, and retained earnings. So these are the accounts we are using in order, and these are the numbers which are generated, system generated. So when you do transactions in a system, so there is a specific number for each account. So these 111, 141, 151, 191, these are the numbers of the accounts, but that is for every system it's a different number, so don't need to worry about it. Just then try to understand the basic idea or the concept that the head of the account, what we're gonna do. So these are the revenue accounts: service revenue and expense, rent expense, salaries expense, and utilities. So these are all the accounts we gonna use it to record the transactions. Now, as I mentioned, it's a double entry system. Double entry system of accounting uses debit and credit to record the dual effect of each transaction. So each transaction has a dual effect. One account is going to be debit and the other account is going to be credit. It can be possible that both the accounts, which are debit and credit, can be an asset. It is possible that one account is asset, other account is liability. It is possible that the one account is asset, the other account is shareholders equity. So all these are possible that is going to take a transaction recording. So T account we use just to express the accounts, and T account is in a shape like one side of the T account like this way. One side is a debit side, left side is a debit side, and the right side is a credit side. So we the rule of debit and credit is assets is equal to liabilities plus shareholders equity. So the equation what we discussed in part 1 should be consistent. Whatever transaction we pass, the balance between assets and liabilities plus shareholder is not going to be disturbed. So now, if we learn the rule, and rules are very important to understand and remember it. Now, what account we debit, what account we credit. So as it's a double entry system, and in a double entry system, what we have to do, we have to keep the record in a way that one account is going to be debit, the other account is going to be credit. Now, if the rule is saying if the asset is increasing, like we buy a land, so what is happening? The asset is increasing. So we debit that asset account. We debit that asset account. You see here, if the asset is increasing, we debit. And you remember that we sold certain part of the land, and in that case the land is decreasing or the asset is decreasing. We credit that account, land. So that's a credit when the asset is decreasing. Very opposite to that, if the liabilities are decreasing, we debit, and if the liabilities are increasing, we credit the liability account. We credit the liability account. We are not talking about the other account. We are credit the liability account. So in this case, we are talking about the asset. So the asset which is increasing is going to be debit, and the other we for whatever it is. It can be an other asset, it can be a liability. But the asset which is increasing is going to be debit. The asset which is decreasing is going to be credit. Similarly, the liability which is going to increase is going to credit, and the liabilities which are going to decrease is going to credit. So this is the rule. The third thing, which is very similar like the liability because it's on the other side, is a shareholders equity. Shareholders equity. So shareholders equity, if is increasing, we credit. If it is decreasing, we debit. So this is a rule, and this is a general rule. You have to follow it whatever the entry you pass in your transaction. So assets is equal to liabilities. You see here the debit, this is a debit side. So debit side plus, credit side minus. Liabilities on the other hand, the debit side is minus and credit side is plus. Common stock is again same like a liability. Retained earning is like the liabilities, right? So it's going to be, so retained earning is going to affect. Dividends, debit, dividend pay. So what is going to happen? So it's gonna, if we increase the dividend, so dividend is going to debit and credit the retained earnings. So expenses, same is the case. So we see here that assets always having a debit balance, because assets are the having always a debit balance, because increase in asset is debited. So whenever we have an asset, it should be debit, right? Liabilities have always have a credit balance. Stockholders equity always have a credit balance. Common stock always have a credit balance. Retained earning always have a credit balance. Dividend debit, whatever, whenever we pay dividend, we say dividend paid debit and credit cash or whatever we are saying. So revenue credit, revenue services or revenue from sales, revenue from services, revenue from, so whatever is going to be credit, and expenses are debit. So very simply, if you want to learn this, we can learn it like assets, right, dividends and expenses all are debit. Only these three accounts are debit, the remaining are all credit. What it is? Assets, expenses and dividend. On the other hand, liabilities, stockholders' equity, common stock, retained earning, and revenues all are credit. So that's a rule you have to learn it. Now we pass entries. Now we're gonna learn how to pass the entry. That's a real in accounting books every time. Whether you are using a computer system for recording transactions or in a book, so that the system is also going to do like the same. The first book of entry record is called as a journal. So Tara received 50,000 and issued stocks, shares, right? So debit for increase, so asset is going to be increase. What we do? Credit, because shareholders equity is also increasing, so we credit the shareholders equity, right? Tara purchased land for 40,000. So what is going to happen? Land is increasing, so we debit land, but at the same time the cash is decreasing, which is the asset. So one thing is that we debit cash, we debit land and credit the cash. So how we can add up to the equity, additional stockholders equity account, revenue, expense and dividend. So assets, liabilities and shareholders equity. Shareholders equity is going to affect by common stock increase the shareholders equity. Retained earning is going to be add up to the shareholders equity minus dividend plus revenue minus expenses. So dividend and expenses is going to reduce the stockholders equity, otherwise common stock, retained earning and revenue is going to increase. Now as I mentioned, the first book what we use to first book what we use for recording our transaction is journal, and we call it as a journal. And journal is basically recording each and every transaction in a chronological order, like in a on a date and time basis. So we call it as a chronological order, means in the order of the time and the sequence of the transaction. So if some transaction takes place first, we record it first and then comes the second. Now, three steps involved in recording those transactions. Specify each account affected by the transaction. So what two accounts is going to, maybe three, four is also possible in a complex type or a compound type of transaction. But normally what we have to do, we have to identify the what accounts are going to affect. Like buy a land in our example. So we see that, okay, the land is a one account under asset, the other account is cash. So these two accounts are going to affect. So this is the first step. Determine if each account is increased or decreased. And we see now land is increased, so we debit land, cash is decreased, so we credit cash. So this increase and decrease give us that which is going to debit and which is going to credit. And then we have to record the journal. So this is the way that you see here. When we invested, what is increasing? Cash is increasing, so we debit cash. What is increasing? The shareholders equity is increasing, so we credit the common stock, so issue of common stock. Then after journal, when we record the transactions, the second step is that we summarize. How do we summarize it? The summarizing is a ledger. Every account has its own ledger, and the transactions are entered into journal, and from there we transferred the balances to the ledger, each transaction. So if we have 100 accounts, different assets, liabilities, shareholder, so we going to make 100 ledgers. Each account has a ledger. If we have a 50 accounts or a 30 accounts, we're gonna make 30 ledgers of each account separately. Then we, over a period like for a 1 month or a 6 months or a year, we make a ledger of each account, and then we have a balances of these ledgers. Some, for example, there's a cash. So cash is sometimes credit, debit, credit, debit, credit, debit, debit, credit. So by this way, at the end we calculated how much is the total debit and how much is the total credit. So cash should be of a debit balance of certain amount. So that is the cash. We're gonna use it as their ledger balance. What we call it as a ledger balance. So cash ledger balance, accounts payable ledger balance. Each every account, accounts payable, accounts receivable, cash, land, building, equipment, common stock, retained earning, dividend account. So all these have a ledger accounts, and the ledger accounts are transferred. So you see here that this is a entry cash and common stock. So cash is going to be on the ledger of cash, and common stock is going to be on the stock ledger of common stock. So what is the flow of our accounting data? We see here that transaction occurred. We pause the transaction. Transactions are analyzed, and transaction enter into the journal. So transaction posted to the ledger, and so this is the process. Transaction occurred, like a exchange takes place. Then we analyze that which account is going to increase, which account is going to decrease, and then we post the transaction into journal, and then from journal, and if it is going through the system is also doing like this. Like if you are using Quick or any other accounting software, so what is going to happen, that when you enter the data, you enter the data of any transaction into the journal, and system automatically transfer those balances to the ledger, and at the end of the month or at the end of a week or a day maybe, you get the ledger balances, and those ledger balances are important for the preparation of a trial balance. So this is an asset, and under asset we have a cash. You see, this is a cash ledger. This is an accounts receivable ledger, and these are the balances what I am talking about. But these are the balances after a certain time period. We have a liabilities. We have a balance for accounts payable, and then we have a shareholders equity. Shareholders equity, and under shareholder equities we have a revenue account with a balance of 10,000, and the expense account, and under expense we have a three different types of expense: rent expense, utilities expense, and other expense. Now these ledger balances which I showed you here, like this balance or this balance or this balance, or these balances, uh, these balances is going to transfer to the trial balance. And trial balance is the first statement that is required to prepare other financial statements. So list of all accounts with their balances, trial balances, list of all accounts with their balances, assets listed first, then liabilities and stockholders equity, shows that debit equals credit, and the trial balance should be equal, in the sense that because we are taking the debit and credit double entry system, and in a double entry system the everything what we debit should be credit as well. So the trial balance should be equal on both sides, on the debit side as well as on the liability side. So asset listed first and then liabilities and shareholders equity shows that debit equals credit, usually prepared at the end of the period, accounting period. Like we so you see the process. We record the transactions into journal, and from journal we transferred the balance every transaction into their respective ledgers. And ledgers, after a certain time period or accounting period, we take the balances from the ledger to prepare the trial balance. So the use of the trial balances facilitate preparation of the financial statement. So if you look at the uh, Terra Corporation trial balance, so you see here there's a debit column and there's a credit column, and these are all the accounts what we use to record these 9 10 entries: cash, accounts receivable, office supplies, land, accounts payable, common shares, dividend, service revenue, rent expenses, salary expenses, and utility expenses. So these are all. So and we see the important point here that these two should be equal. There is no difference. So what we learn in this chapter is how to record transactions. One account should be debit, the other account should be credit, and what are the rules for. So all assets increase is going to be debit, decrease credit. All liabilities increase should be credit, and decrease should be debit. Shareholders equity increase should be credit, decrease should be debit. And revenue, all revenues are credit, and all expenses are debit. So all revenues are credit and all expenses are debit. So this is the rule. You have to practice it, and by this practice you're gonna be is going to be your second nature, that whenever you pass a transaction, so you understand that okay, this account is going to be debit or this account is going to be credit. So in this chapter what we learn is this basic idea or the rule of transactions, and we also learn that the accounting process, how the accounting process. So accounting process starts from journal, and then ledger, and then trial balance, and then after trial balance we prepare the financial statements. So this is all I want to share with you from this chapter or this topic of recording business transactions. I hope you enjoyed it. Thank you very much. Bye bye.